Most people look at a stock chart and see a bunch of random squiggly lines. And because they can't read it, they either ignore charts completely, or worse, they make emotional decisions based on gut feelings. But here's the thing. Charts are just the history of a stock told in pictures. And once you know how to read that picture, you'll spot things that other people completely miss. And in the next 15 minutes, I'm going to teach you how to read a stock chart from scratch. No experience required. By the end of this video, you'll understand candlesticks, support and resistance, moving averages, and 2 momentum indicators that traders use every single day. Let's get into it. A stock chart is just a visual record of a stock's price over time. The horizontal axis, the bottom, is time. Could be days, weeks, months, years. The vertical axis, the side, is price. Every point on that chart tells you, at this moment in time, this is what people were willing to pay for 1 share. That's it. The whole chart is just price over time. Now, there are a few different ways to display that price data. The most common, and the most useful, is the candlestick chart. Each candlestick represents 1 time period. If you're looking at a daily chart, each candle is 1 trading day. Here's how to read a single candle. The body of the candle shows the range between the opening price and the closing price. If the stock closed higher than it opened, the candle is green. The bottom of the body is the open. The top is the close. If the stock closed lower than it opened, the candle is red. The top of the body is the open. The bottom is the close. The thin lines sticking up and down from the body, those are called wicks or shadows. They show you the highest and lowest prices the stock hit during that period, even if it didn't close there. So a green candle with a long bottom wick? That means the stock dipped hard intraday, but buyers stepped in and pushed it back up. That's a bullish signal. A red candle with a long top wick? Stock tried to rally, got rejected, and closed weak. Bears are in control. Once you start reading candles, you can't stop seeing them everywhere. Now let's talk about the most important concept in all of technical analysis: support and resistance. Support is a price level where a stock tends to stop falling and bounce back up. Think of it like a floor. Every time the stock drops to that level, buyers show up. Resistance is the opposite. It's a price level where the stock tends to stall and pull back. Think of it like a ceiling. Every time the stock pushes up to that price, sellers take over. Why do these levels exist? Because of human psychology and memory. If a lot of people bought a stock at $50 and it dropped to $40, they're sitting on a loss. The second it gets back to $50, they sell, just to break even. That selling pressure creates resistance. Here's the key rule. When a resistance level gets broken, it often becomes support. When a support level breaks, it often becomes resistance. Traders call this a flip, and it's one of the most powerful patterns in charting. All right, support and resistance shows you key price levels. Moving averages show you the trend. A moving average smooths out all the daily noise and gives you a cleaner picture of where the stock is actually heading. The 2 you need to know are the 50-day moving average and the 200-day moving average. The 50-day MA is the average closing price over the last 50 trading days. The 200-day MA is the average closing price over the last 200 days. When a stock is trading above both moving averages, it's generally in an uptrend. Buyers are in control. When a stock drops below both moving averages, it's in a downtrend. Sellers have the upper hand. Now here's the big moment traders watch for. When the 50-day cross is above the 200-day moving average, that's called a golden cross. It's a bullish signal, a sign the stock may be shifting into a longer-term uptrend. When the 50-day crosses below the 200-day, that's called a death cross. Bearish. The longer-term trend may be turning negative. These crossovers don't predict the future. Nothing does. But they're widely watched signals that can identify momentum shifts before they're obvious. One thing most beginners ignore completely: volume. Volume is the number of shares traded in a given period. You'll see it as bars along the bottom of the chart. Here's why it matters. Price moves on high volume are much more significant than price moves on low volume. If a stock breaks through a resistance level on massive volume, that's a real breakout. Conviction is there. If it barely edges through resistance on light volume, that's a fake out. Be skeptical. Same with drops. A sell-off on huge volume often means panic and institution selling. A dip on light volume might just be noise. Always check the volume bar. It tells you how much conviction is behind the move. Now let's add two momentum indicators. These lie below the price chart and help you measure how fast a stock is moving and whether it might be overdone. First up, RSI, the Relative Strength Index. RSI is a number between 0 and 100 that tells you whether a stock is overbought or oversold. The rule of thumb: RSI above 70 and overbought. The stock has run hard and fast. A pullback may be coming. RSI below 30 equals oversold. The stock has been beaten down. A bounce might be near. Now, overbought doesn't mean sell immediately, and oversold doesn't mean buy immediately. A strong trending stock can stay overbought for weeks. But when RSI starts rolling over from overbought territory, that's when you pay attention. RSI is a tool. Use it alongside everything else, not in isolation. The second momentum indicator, MACD, Moving Average Convergence Divergence. Fancy name, simple idea. MACD measures the relationship between two moving averages to tell you whether momentum is building or fading. You'll see three things on a MACD indicator. 1. The MACD line. 2. The signal line. 3. The histogram, bars showing the gap between the two lines. The signal you're looking for. When the MACD line crosses above them, of the signal line, bullish momentum is building. Potential buy signal. When the MACD line crosses below the signal line, momentum is fading. Potential sell signal. The histogram tells you how strong or weak that momentum is. Bigger bars equals stronger move. Shrinking bars equals the move is losing steam. Like RSI, MACD, ZOI isn't a crystal ball. But when MACD gives a bullish crossover and the stock is holding above a support level and volume is picking up, now you're looking at a setup that traders take seriously. Let me show you how all of this works together on a real chart. Look at the price action here. Notice the 200-day moving average acting as support. Every time the stock dips toward it, buyers step in. Now look at that resistance level up here. The stock tested it 3 times before finally breaking through on this high-volume day. That's a textbook breakout. And check RSI at that breakout point. It's elevated, but not yet in overbought territory, meaning there was still room to run. MACD. Bullish crossover right around the same time the price broke out. Everything confirmed. This is how professionals think about charts, not the line went up, but multiple signals are aligning. You now know more about reading stock charts than most retail investors ever learn. Candlesticks, support and resistance. Moving averages. Volume, RSI. MACD. That's the toolkit. The best thing you can do now is practice. Open up any free charting tool. TradingView is free and excellent. Pick a stock you know and just start reading it. Look for support levels. Find the moving averages. Check RSI. Charts get easier every time you look at one. It's a skill, not magic. If you want to go deeper, I've linked my favorite books on investing and trading below. If this video helped you, drop a like. It genuinely helps this channel grow. Subscribe if you want more videos like this, and I'll see you in the next one.